Look at the infrastructure. Power grids are failing, and physical networks are buckling under the pressure of regional instability. In Eastern Europe, active combat zones are damaging neighborhoods and stalling regional economies. Out on the oceans, major shipping routes are facing disruptions, creating bottlenecks in supply chains and driving energy costs higher. Standard economic theory suggests that under these conditions, global stock markets should be in a freefall, while capital flees to safety. Instead, U.S. indices like the Dow Jones are moving past previous highs. This isn't localized to the West. India's Nifty 50 is also hitting record numbers. The physical world is absorbing supply shocks and violence, while the financial world is generating wealth. This is the war and wealth paradox, a moment where market performance has separated from the human experience on the ground. This disconnect exists because markets prioritize one variable above all others: certainty. While they react poorly to the unknown, they can adapt to almost any known quantity. This creates what traders call a wall of worry. It describes a trend where markets gain value even as negative macroeconomic headlines dominate the news cycle. Institutional models have already quantified the risks of the current wars. By accounting for the worst-case scenarios in their pricing, they remove the element of surprise that usually triggers a panic. As long as data suggests these conflicts will remain regional, funds view the instability as a baseline, moving capital in to buy the dip. To Wall Street, predictable instability isn't a threat. It's a data point that has already been priced in. The International Monetary Fund's July 2026 report describes this phenomenon as crosscurrents in the global economy. One current is pulling downward. Nations dependent on imported oil are watching their citizens struggle with inflation and energy shocks. But a second current in the tech supply chains of the US, India, and Taiwan is so large that it tips the global balance in the other direction. Because major stock indices are heavily weighted toward a handful of massive tech giants, their profits offset the economic pain felt by the average consumer. Historically, when geopolitics turned volatile, investors sought safety in gold. In 2026, capital is seeking refuge in aerospace and defense contractors. Rising tensions are forcing nations to expand defense budgets. These companies are locking in multi-year government contracts that remain resilient even as consumer inflation rises. A second safe harbor has emerged in the AI capital expenditure cycle. Tech giants are currently spending hundreds of billions on data centers and power grids. This spending continues regardless of whether shipping lanes are blocked or oil prices fluctuate. These specific, high-spending sectors are the actual engines keeping the broader market indices at record levels. These trends show that the stock market tracks corporate earnings, which can function independently of geopolitical stability or moral outcomes. The entities dominating the economy are selling weapons for regional conflicts or hardware for the AI revolution. But this stability relies on those two pillars. If AI spending slows or defense budgets are cut, the narrative keeping these indices at record highs will shatter. The mechanics of wealth have shifted. The question is whether these sectors can continue to decouple from the broader economy, or if we are simply watching a new kind of bubble form. To keep tracking how these hidden geopolitics move your money, hit the subscribe button. I'll see you in the next breakdown.